Billionaire investor Peter Thiel, best known for co-founding Palantir Technologies, has once again captured Wall Street's attention after making several bold portfolio adjustments. During quarter 3, Thiel initiated a new stake in Microsoft, while sharply reducing exposure to two of the most talked about technology companies in the market. These moves reveal a clear shift in capital allocation and offer valuable insight into how one of Silicon Valley's most influential thinkers views the future of artificial intelligence, cloud computing, and long-term technological dominance. Although Palantir Technologies helped define his public image, Thiel also oversees the hedge fund Thiel Macro, which actively trades public equity. In quarter 3, the fund executed 3 eye-catching transactions. It completely exited its position in Nvidia, trimmed its stake in Tesla by 76%, and opened a substantial new position in Microsoft. Among these decisions, the Microsoft purchase stands out the most. Despite being a mature technology giant, Microsoft now represents approximately 34% of Thiel Macro's invested assets. That level of conviction is remarkable when you consider Microsoft's long track record. Since its initial public offering in March 19, 1986, the stock has delivered a cumulative return of roughly 483,000%. In other words, Microsoft has already been one of the most successful investments in market history. Even so, Thiel appears confident that the company's best days are not behind it, but still ahead. To understand the reasoning behind these portfolio shifts, it helps to break down the investment case for each company, starting with Nvidia. Nvidia is widely recognized as the leader in graphics processing units. These processors are especially critical for artificial intelligence training and inference inside modern data centers. Over time, Nvidia has expanded far beyond chips alone, building a comprehensive ecosystem that includes central processing units, networking hardware, and advanced software development tools. This full-stack approach has allowed Nvidia to dominate the artificial intelligence accelerator market, where it controls more than 80% of total share. Despite that leadership, Thiel chose to sell out of Nvidia entirely in quarter 3. One possible explanation is increasing competition from companies such as Broadcom and Marvell Technology, which have developed custom artificial intelligence chips for major customers like Alphabet and Amazon. While these tailored chips may reduce costs for specific use cases, they are unlikely to significantly disrupt Nvidia's position, as the total cost of operations often favors Nvidia's integrated platform. Another potential factor behind the exit could be geopolitical risk. Export restrictions previously prevented Nvidia from selling advanced chips into China, which is the second largest artificial intelligence market in the world. Such limitations naturally create uncertainty around future growth. However, that concern may be easing, a development that could act as a meaningful and unexpected growth catalyst for the company. From a financial standpoint, Nvidia still appears compelling. Wall Street analysts expect adjusted earnings to grow at an annual rate of 67% through the period ending in January 2027. With shares trading at roughly 46 times earnings, the valuation looks surprisingly modest given the company's growth profile. Nvidia has also exceeded consensus earnings expectations by 3% in each of the past 6 quarters, demonstrating consistent execution. From a long-term perspective, patient investors may view Nvidia's current valuation as an opportunity rather than a warning sign. Tesla presents a much more complex and controversial investment story. In recent years, the company has faced a variety of headwinds, including elevated interest rates that have weighed on consumer demand and public backlash related to Elon Musk's political activities. While global electric vehicle sales climbed by 33% during the 12-month period ending in October 2025, Tesla moved in the opposite direction. Revenue declined, and the company's global market share dropped by 5 percentage points. Adding to the pressure, Tesla lost its status as the world's leading electric vehicle manufacturer. Given the competitive landscape and pricing pressures, it appears unlikely that Tesla will regain that top position in the foreseeable future. These challenges help explain why Peter Thiel reduced his Tesla stake so dramatically in quarter 3. Even so, the long-term investment thesis for Tesla does not hinge solely on vehicle sales. Instead, it revolves around autonomous driving technology and humanoid robotics. Tesla's approach to self-driving relies on vision-based systems that interpret the environment using cameras rather than a combination of cameras, radar, and LiDAR. This strategy is designed to be more cost-efficient and easier to scale, since it does not require highly detailed mapping of every city before deployment. At the moment, Tesla's robotaxi operations remain limited to San Francisco and Austin, despite earlier statements from Elon Musk suggesting the service would reach half of the population of the United States by the end of 2025. 2025. Looking ahead, Tesla plans to expand robotaxi operations into 5 additional cities, including Dallas, Houston, Las Vegas, Miami, and Phoenix. Analysts at Morgan Stanley believe Tesla remains the technological leader in a future mobility market that could approach $4 trillion by the year 2040. It is also important to note that despite selling a significant portion of his Tesla shares, Peter Thiel still holds Tesla as his largest individual position. Wall Street expects Tesla's adjusted earnings to grow at an annual rate of 8% through 2026. At the same time, the stock trades at approximately 235 times earnings, a valuation that appears extremely expensive by traditional standards. However, Tesla is often best viewed as a very long-term investment, potentially spanning 10 to 15 years, as widespread adoption of autonomous vehicles and robotics will take time to materialize. Microsoft, on the other hand, offers a more balanced combination of scale, stability, and artificial intelligence-driven growth. As the largest enterprise software provider in the world, Microsoft is uniquely positioned to monetize artificial intelligence across its massive customer base. The company has embedded generative artificial intelligence copilots throughout its office productivity tools, cybersecurity platforms, enterprise resource planning systems, and low-code development software. User adoption has accelerated rapidly. Monthly active users reached 150 million during the September quarter, up from 100 million in the June quarter. This surge highlights strong demand for artificial intelligence-enhanced productivity tools across businesses of all sizes. Beyond software, Microsoft Azure plays a critical role in the company's growth strategy. Azure is currently the second largest cloud services provider when measured by infrastructure and platform services revenue. Azure has gained approximately 3 percentage points of market share, even as capacity constraints limited near-term growth. To address this, Microsoft has been aggressively expanding its data center footprint around the globe. According to Morgan Stanley's most recent Chief Information Officer survey, Azure is ranked as the cloud provider most likely to gain additional market share over the next 3 years. This outlook underscores Microsoft's ability to pair artificial intelligence innovation with the scale and reliability demanded by large enterprises. From a valuation perspective, Wall Street expects Microsoft's adjusted earnings to grow at an annual rate of 16% through the period ending in June 2027. Shares currently trade at about 33 times earnings, which may appear somewhat expensive compared to the broader market. However, Microsoft has exceeded consensus earnings estimates by an average of 8% over the past 4 quarters, making the valuation easier to justify. This consistent outperformance helps explain why Peter Thiel allocated such a large portion of his hedge fund's assets to Microsoft. Taken together, these portfolio moves paint a clear picture. Peter Thiel appears to be rotating away from near-term volatility and competitive uncertainty toward companies with durable platforms, deep enterprise relationships, and long-term artificial intelligence monetization strategies. While Nvidia and Tesla each offer compelling narratives, Microsoft stands out as a business capable of delivering steady growth while shaping the future of artificial intelligence at scale. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.